Can you have a whole life insurance policy that is designed for maximum cash value if you're only paying a small dollar amount? The answer is absolutely yes. Now, to provide some more detail to that, when I say small amount of money, if you're considering paying perhaps $100 per month, $200 per month, maybe $300 per month, can you still have a policy that is designed, call it $250 per month, let's use that number, a total of $3,000 per year. Can you have approximately $300 per year directed toward the premium and everything else toward PUAs to maximize the cash value to the same degree that someone would if they're paying in $100,000 per year and they have a $10,000 minimum premium? The answer is yes. Now, there are factors that can have an impact on that, such as company and product minimums, our age, the health rating on a product. But generally speaking, we can easily have a policy where we can have maximum cash value, even with a smaller dollar amount going in. So in this case study, we're going to look at a situation that is similar to where I started with my first policy. We're going to look at a 25-year-old individual considering $3,000 per year, or $250 per month. When I started my first policy, I was right around 23 or 24 years old. The total dollar amount I had paid in was just under $200 per month, but it actually was a combination of a whole life insurance policy and a convertible term policy. And if I could go back in time, just with the knowledge I have now and go back then, I would not have done the convertible term policy. I'm not a huge fan of them because when you convert them to whole life, there's limitations where you can't customize it to the same degree that you can with a new policy, a fully underwritten one. But there are advantages to convertible term as well. And at the time, I didn't know as much. But anyway, my point is, my whole life policy was even smaller than $200 per month because I had a term policy as well. And what I also want to add in this is when I started that first policy, it was a stretch for me. There were times I almost lapsed it. I almost had to cancel it because I couldn't afford it. Why I took it out was mainly because I wanted to walk the walk as I'm discussing whole life insurance with potential prospects, trying to convince them to open a policy. It's much, much easier to say, hey, I own this as well. Here's my policy. Here's what it's set up for. Here's how it works, as opposed to saying it's a good idea, but I don't own it because I can't afford it or I don't believe in it, whatever it might be. No, I wanted to walk the walk. So I took that chance, and it was a struggle, but I'm glad that I did it as I look back in time. And also what I'll add just about our company is, over the years, we've considered the idea, a lot of people have recommended this to us, working with people that have larger amounts of money going into policies. And mainly because of my background working on modeling policies for corporations that are typically paying a lot of money into whole life insurance policies for maximum cash value. Individuals like to do that as well. And from a profitability standpoint, it can make sense. But with all that said, working with someone starting where I started, regardless of their age, if they say, hey, I can only afford $250 per month, maybe it's $100 per month right now, it's a smaller policy, but I'd like to get started. If that was me at that point in time asking someone for help, I'd appreciate it if they helped me. If they said no, I would understand it. But at the same time, as a company, we have made a decision to really serve everyone. As we continue to grow, it fits into our mission statement as a company, as we continue just to push forward in the industry. Like, we want to make it a point to help everyone regardless of the dollar amount. But anyway, I did want to make sure I interjected that because we discussed it as a company recently, and we always have discussions on it. But no, we work with everyone. This is very similar to where I started. I still have this policy, actually. You have to start somewhere, and everyone should be treated equally, in my opinion. So his desired funding in this particular scenario, $3,000 per year we're going to look at, $250 per month. Now, he wants to see the same options as the person funding $100,000 per year. So as he sees different content and such on our channel, we see examples with $100K per year. I see a funding period of 7 years. What does it look like if I pay into the policy for 7 years and stop? That's what he would like to see, so we're going to show him that. Then, looking at the same policy in different products, where I fund it for 15 years, That'll take him up to the age of 40. And then also, what's it look like if I fund it for 30 years? We almost put an option together funding it for 50 years, but he can easily do that with this option. We're just going to show 7, 15, and 30 in this particular case, all of $3,000 per year. So, company selection. We'll look at options with MassMutual and Guardian. MassMutual easily allows a policyholder to adjust payments one time per year, every year on the anniversary date without any medical underwriting. There's a bit more to that on some of our MassMutual content. And Guardian's great if he says, hey, I'd like to be able to get $3,000 per year in, but I don't know if I could always hit that. There's some months where things are a bit tight and I get that 100% as I've been there. When I had my first policy, the $180 or $190 per month I had was tight sometimes. So what we're going to look at from a design standpoint is some designs where he has a minimum premium of just over $300 per year. That can be paid monthly as well. And then he can pour excess funds into PUAs. So Guardian does allow that with that PUA flexibility. Mass is great with a one-time per year payment adjustment. And if he wants to keep max funding it for something like 30 years, MassMutual has a sweet spot for that type of design and that type of funding, in my opinion. Loans. He does want to look at loans for future car purchases and retirement as well, right? So as he continues to build this up over time, what's the cash value potentially look like? And then what can I pull from it down the road? So we're not going to look at these two loan scenarios. However, that is what he plans on using the policy for. We do show that kind of stuff to everyone we work with as well, especially when they want to see it before and after they start the policy. So with the policy design, where is your money going? The fun part, premium or the PUA component? The premium piece, $300. So it's not quite at $300. The lowest we were able to get it in one particular example is right around $320. That's the annual premium, which does not show up in cash value in the first year. Beginning the second year, it does show up in cash value. Now, we also looked at some other products which had lower or higher minimums. Some were $800 minimum premium. Some were around an $1,100 minimum premium. But those would be the minimums where he can still pay up to $3,000 per year. What I'll also add in this particular case is when someone's looking at a policy like this, if it's $3,000 per year, a question I would ask is how much do you want the ability to add in the future? Meaning, do you ever want to be able to add more than $3,000? If the answer is, oh yeah, I definitely want to be able to get more into it. Well, what you could do is if we set the policy at, or the policy premium at, call it $1,000 per year, did you know we could do that and actually set the MEC limit at $10K per year? You can still pay in $3,000 per year, but build in window room to add up to $10K per year. This way, as your income increases over the years, you can shovel more money into the policy without the need to start all over the new policy, going through expenses again. That is an option. But what I'll show in that particular case is what does it look like with a minimum $300 premium compared to that same funding of $3K per year, but with the $1,000 premium. Because the higher the premium, if I don't add more, it'll hurt me more than it can potentially help me. So that's the kind of stuff I like to see up front. But going back to the 3K example, so we've got a couple different dollar amounts with a minimum premium. Term rider, you're going to see, is less than $50. Purpose of that, great way to inflate the death benefit, which does what? Gets our MEC limit where we want it. In this case, a minimum of $3,000. And then everything else, plowing into PUAs, which is money he sees right away. He can access it, begins compounding for him, but he has it there. In the event that life happens, he has access to that cash value. When does life happen more frequently? After you've been working for a number of years, you have experience with life, business, your profession, you've saved up money, or in the early years when you think everything's going to be great, and then you learn that, I'm dealing with life and I've got to try and get through everything. This is a lot harder than what I thought it would be going out my own. When's life going to happen more? When you need access to cash value more. When you're younger, at least it was for me, and I think it is for just about everybody, because life experiences, they're going to happen, stuff happens, life happens at the end of the day. So let's look at some numbers here and have some fun. First, let's break down one of the examples with respect to where his money's going. So this example is a 7-year fund. Breakdown, minimum premium, $323.75 per year. Now, his true minimum commitment would actually be higher than this. The reason why is as follows. We couldn't get this down to a net of $300, only because the lowest we can drive the base face amount, which drives the premium, is $25K. We got it pretty close, but it's not a clean 10% minimum premium. Then this guy, target additional benefit, is a term insurance rider, cost-effective way to raise the death benefit and MEC limit. There you go. Just over $40 per year. Initially, that cost will decrease as the years pass. And it also is eliminated in this case after year 7 as we chop the term rider off altogether. Now, what I want to add in this particular case is around the minimum. This is with Guardian. Their paid up additions rider. Here we just scheduled everything. In order to have the option to add PUAs into the policy on an unscheduled basis, so I've got Guardian policies where I can do that. I can log onto my portal and just throw money into PUAs anytime I want. In order to do that, Guardian does require, and this is specific to Guardian, all companies typically have different PUA rules, requires a minimum of $250 per year. So in this particular case, what would that mean? If this is your policy and you want the option just to dump money into PUAs anytime you want, the true minimum requirement would be the base premium and this $250 per year. If you want to round off, that would be what, about $575, call it $600 per year on the minimum. And that $250 can include the cost of the term rider as well. So it's always good to be aware of that. If my term rider cost is $300, that does count as the $250 scheduled PUA. So those two are usually blended together, which is nice. But I do want that transparency, especially if I'm very, very focused on what the minimum is, to say, hey, you know, my premium's $300 and change, but if I want the option to commit to the minimum and add more, my true minimum in this case would be $600 per year. Great to know that in advance. So this particular example is our 7-year fund. Actually, this is the 7-year fund. Same exact thing here, you'll notice. Everything's identical. The wrong slide up or illustration up. Here we go. $3,000 per year for 7 years. After that, not a penny paid. When's your break-even point? Year 6, you've paid an $18,000. You have $18,000 in cash value. So by year 6, if I'm paying more money into this product, if it's an example where, like you see frequently, $30,000, $50,000, $100,000 per year, this break even will usually be right around year 5 with this particular product. With less money going in, I'm in a lower tier, or the insurance company will refer to it as a band. It has to do with the base face amount. It slightly lowers the IRR and break even as a result, but very, very close, very similar ratios with the maximum cash value design. So here, $21,000 going in. This is a Guardian policy, which a 7-year fund is a sweet spot in my opinion with them. If he wants to continue to pay into it, if he says, hey, I like this idea, I like the cash-rich design up front, but I think I want to continue to pay in beyond 7 years. Remember, 7 years, 15 years, and 30 years is what we're going to look at. So here we go. Exact same policy, but what it looks like if he decides to continue to pay in $600 per year. And he can pay in more in this particular example. He can easily pay up to $1,000 per year, actually a total of $1,200 per year if he wants to. But here, we just want to illustrate what's it look like if I continue to pay the minimum. It's a scenario, one of many. And there's your cash value, about $82,000 30 years down the road. And we can pump more in if we wanted to, which we're going to show you next. But our Guardian examples, breakdowns of where the money's going. Here is the 15 pay option. Premium, about $800. 802.5 to be precise. Then we've got money going toward $84 toward a term rider, everything else into PUAs. Here's the $3K per year. I'm highlighting years 6 and 7 because there's your break-even point when you have more money in cash value than what you've paid in. This is very, very important and interesting to a lot of people, which is why we always highlight it. Funding it for how long? 15 years, up until age 40, nothing thereafter. So here we see 0, 0, 0. Lets it continue to ride. MEC limit was initially at 5,000 and change. So this was equipped with additional window room if you wanted to add more money into the policy. But what does cash value look like? Here's his money column, total cash value, 116 by year 30. Okay, and then we ran 2 additional options with mass, high early cash value products, also breaking even between 6 and 7. What we did here was show an example of what it looks like if he funds it for 15 years and stops, and then the exact same option, or exact same policy, where he decides to keep pumping money in for 30 years. Because at age 25, it is very, very fair to assume or safe to say, I don't know how long I'm going to want to pay into it. I might want to keep pumping in because I'm young and my income is likely going to increase, so we want to equip the policy for that. But then some youngsters say, hey, I'd like to start a policy where I just fund it at the maximum level for a short period of time. I'm done. It's my small policy, starts out as a baby tree, continues to grow, and then when my income really increases, then I'll start a larger policy. Always a matter of preference. Give everyone those options and that choice, regardless of their financial situation. So let's look at a overall side-by-side comparison here and have some fun. So here are the Mass Mutual options. So as you look at these side-by-sides, here's what I like to look at. Here's the 15-pay option, which will have the strongest internal rate of return, maximizing the cash value. Year 1, he pays in $3,000. The base premium in this example was about $800. We don't have on the spreadsheet. We did go through it in the illustration though. So year 1, I pay in $3,000. I have about $2,300. So no matter how I slice this, because the company's dividend interest rate for 2022 is 6%, year 1, that's a negative 23, almost 24% hit on my money. That's a lot in the first year, especially if I need the money. If I need the money when I'm young, and I'm trying to get things going, if I'm paycheck to paycheck or at any age really, I would not recommend starting a policy until I have that cash built up first, just as a buffer. That's something I firmly believe in. Next year, I pay in $3,000. It grows from $2,289 to $4,873. It's less than $3,000. That is why I see a negative 7.86% internal rate of return in year 2. Year 3, pay in $3,000. It grows from $48 to $78. Just about all of it back minus $70. That's why I see that negative 0.88% internal rate of return. I did not get the full $3,000 back that I paid in this year. When I'm 29, if I'm still going down this path, $3,000 grows from 78 to 10,800 and change, more back than what I paid in, 0.78%. Breaks even between years 6 and 7. IRR gets stronger and stronger over time. Again, based on the present dividend interest rate. This will change as the years pass. But strong IRR for a small policy, funded for just 15 years in this case, $3,000 per year, to be a total of $45K. Not bad, just as we look at the growth over time. Then we look at the other 2 options. So with a 15-pay product, how long can you pay into it? Maximum of 15 years, oopsie daisy, which is this option right here. This policy allows him to pay into it up until the age of 85 if he wants to. So what we did here was first show the same option, funding for 15 years. If your intention is to stop after 15 years, or if you think, hey, I really like that idea, then which one would I select? Probably this one. I've got more cash value, and it does grow at a faster rate as the years pass as well. It's designed for a stronger internal rate of return. It's more geared toward cash value long term. This product, however, similar cash values, but gives me the option or ability to fund beyond 15 years, again, up until age 85 if I wanted to. Now, one difference with this, the lowest we could drive the minimum premium, as this product has a higher minimum, was about $1,100. However, a decent chunk of that comes back to cash value, about 80% minus the PUA fees, but I'm at about $2,600 right off the bat. Negative 12% hit initially. So less pain up front. Those are the years where it's impacting my balance sheet, personal or business balance sheet, more than anywhere else. All right, let's look at the Guardian examples. Here we go. What do we notice? 7 years. These are the same as the illustrations. 7 years and stop, cut the term rider, go reduced paid up. And then here, exact same policy. We don't cut the term rider though, and continue to fund just a minimum of $600 per year. And this is the kind of stuff that we like to play around with different numbers. If you're watching this, you may have worked with me before or any of our agents, where a lot of times we'll connect with someone and just walk through the software, different funding scenarios. Hey, what's it look like if I pull this lever, if I cut the term rider early, if I keep funding it for a period of time? That's my favorite part. Like, that's what I did for years. When I was 25, might have been 26, however old I was, meeting with people one-on-one, just going through that, time after time after time. But that's the fun part. And then seeing how the policy performs. But anyway, a lot of info in this case study, mainly to answer the question, can I have a policy with a low dollar amount, a small amount of money? And the answer is absolutely yes. So I hope that this case study was helpful. If you enjoyed it, please hit the like button, subscribe for more. We do appreciate it. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.